Over to you, Stephen Burke, and
Thanks, Mark.
enlighten us, please.
We'll give it a shot. So I wanted to just talk more about the global economy because I've been spending a lot of time talking about the US economy for the last couple of calls with all the stuff going on in Washington, D.C. and inflation concerns. But I thought it'd be worth taking a look around the world and then cover two things that I might have gotten wrong and address them. There's a lot more that I've gotten wrong in the last year that we've been doing this, but these two are pretty fresh. So just overall on the global economy, we were roughly about 87 trillion in dollars last year in 19. We dropped down to about 85 trillion globally. And now we're looking to do almost 95 trillion this year, on our way to 102 trillion next year. Advanced economies are up quite a bit, about 6 trillion to 56 trillion this year. Emerging economies and developing economies are up about $4.5 trillion. So it's been an interesting rebound. But what's particularly challenging is how uneven the recovery is and what are the implications of that and what are the reasons for it. So let's start with why the recovery has been so uneven. I think we've had very significant different starting points for the different regions following the financial crisis and entering into the pandemic. So those different starting points actually led to policy choices, both monetary, fiscal, and health choices that put countries on a different path. And clearly the US was the most aggressive in the financial crisis and followed through being very aggressive coming out of that. Europe took a more anti-inflationary approach and went for more austerity to deal with their debt problems. The US added debt, but globally we've gone from about 202 trillion in debt or 207 trillion in debt following the financial crisis to now we're over 270 trillion of debt. So that actually has weighed very heavily on how countries have responded. We've done an incredible job globally of containing the risks, in large part because of the massive stimulus that's been put out there to support the economy, but it's creating now newer problems, and the problems are being felt pretty broadly. One of them is the inflation and concern. It is showing signs of being more persistent. We'll touch on that. But we think that eventually you're going to start to see, and not too far out, you're going to start to see some of the deflationary forces rearing their heads. China, for example, today just announced that they were, their birth rate was very weak for last year. They could be turning negative in population growth as soon as this year. So there are a lot of issues around, and inflation being one of them, but the deflationary force of demographics, we think, is one that is going to be persistent for some time, and that is going to continue to weigh. The stronger dollar is actually creating some problems, particularly for emerging economies with high dollar debts. And that's starting to really exacerbate itself in creating even more divergences in economies. And so policymakers made two very difficult trade-off decisions in 2009 and March of 2000, which was really to either stimulate or not on your economy, and then how long are you going to carry your country during these crises. What we're left with, though, is policymakers are in a much more difficult spot. And where they go from here is part of the reason I think central banks around the world are being so slow to react to the inflationary pressures is their concerns about how do they move forward, particularly when there's a likelihood of another recession at some point in the next couple of years. How soon or how difficult, a lot of that will depend on how the pandemic plays out. But I think what's all adding up to is we're seeing these major shifts in the economy, but also significant geopolitical climate and social stresses adding to that are making policy choices more difficult. So I'm going to go through a bunch of slides quickly to kind of frame what's going on in the world, the advanced economies, emerging economies in the US. This is GDP growth, and you can see the run we've had for quite some time. And the blue line is emerging economies on the top. The world economy is the lighter gray line. And then as you move down, you'll see the emerging economies in advanced economies in red and the US is in gold. So big dip, big rebound. Emerging economies didn't go down as much, but have rebounded back. So it is pretty synchronized how the economies have reacted. Also around the world, if you look at Global Purchasing Managers Index, still very expansionary. And this is part of the reason why people are thinking we're going to have a strong next year. If you look out, we're looking at anything over 50 is expansionary. The US just had their numbers out today, I think around 59. Even though it's lower than expectations, it is still reflective of an expanding economy. And it's not just the overall manufacturing and services are really in a similar mode. If you look at unemployment in the advanced economies, big skyrocket last year has come back down significantly this year and with more to go. Commodity prices are starting to move down again, except in the metals area and also in the food space. That we're still seeing a move up, but precious metals, some of the energy I expect you'll see a downturn in, particularly with the reserve releases and a coordinated attack to go after inflation by most of the major economies. You are seeing metals continue to push up, and that's an area we think is an investment opportunity because of the new addressable markets that are coming for some of the commodities. Global inflation, you can take a look at. Again, the world is in the gold, the advanced in the red and emerging in the blue. And you are starting to see some moderation in the global headline inflation periods. These are through September. We'll have a little spike up this month, but we expect that overall the inflation should start to ease. But what's interesting, and when you look at this, is we're not talking about historically high levels, even where we are right now. This is a look at advanced economies, and you're looking at anywhere from Japan at 0.4 to the US at 5.2 through September. And we know we had a big pop up in October, but we think there's going to be moderation there. But what's really interesting is the magnitude of scale between the advanced economies, which I go back to and say, all right, 4 to 6%, and the emerging economies, 0 to 20%. Big swings, big differences. And I think it's this upward pressure, particularly in South American nations, we're really starting to feel it. But you're also going to see, as we get the October numbers in India, China, and the energy importers seeing a more of a spike there. But through all of that, look where government bonds are and how low they are historically and where we see them going. And this is the 10-year for advanced economies, and a range of minus 0.2 for the euro area, with Germany at around minus a quarter of a point, up as high as New Zealand and Canada and Australia in the high 1.8, 1.7 range, the US pushing 1.7 today. But the stock markets in the advanced economies have done exceptionally well because of the stimulus that's been put forth. The stock markets in the emerging economies have also done well in many cases. I think South America is a different challenge, but you are seeing some pretty strong moves across the globe because the amount of stimulus that we've put at the problem. But I think we are seeing central banks really in a bind, and part of the divergences we're seeing will be shown in these next couple charts. This is advanced economies, and we're way down from where we were before. And what I would point out is that the US right now, with our central bank policy where it is, one of the things that's important to recognize is when we continue to taper the quantitative purchases that are going on between now and June, we're going to be adding between $400 and $500 billion to GDP, to stimulus. And when you look at that, on what that has as an impact on interest rates, a lot of Fed members think 500 billion is the equivalent of a half a point on lowering rates. So what we're going to do over the next 9 months or 8 months, if we keep on the path that the Fed is talking about, is going to have the effect of putting enough quantitative easing into the system to lower rates in the US, or the effectiveness of the rates would be a half a basis point cut in rates. So that's a challenge that you're going to see central banks in moving in different speeds. But one of the things that the advanced economies are pretty in lockstep in that they are going to believe that they want to see more persistent inflation because they don't see it as being sustainable with their other goals. So I think you're going to see rates stay low. I think the markets are telling you that as they look out, they believe that a couple of years out, we're going to see rates coming down. We think they could see inflation pressures starting to abate the second half of next year. But the emerging economies are telling a different story. And there's been in the emerging markets about 55 increases in rates this year. You're seeing it in Brazil, you're seeing it in Russia. You see some of the strains, I don't have Turkey here, but talk about a case for bad policy and just a highly unusual monetary policy. They believe that cutting rates is the solution to an inflation problem and a currency problem, which I think is going to, it's testing economic orthodoxy. So we'll have to see how that plays out. But this is creating problems that as the US starts to taper and our rates start to drift up, it's going to create more problems for emerging economies and emerging economy debt, particularly those that are their debt are in dollars, and that's going to weaken their currencies and put more strain. Ironically, we believe that will lower the inflationary pressures that we're importing into the US, which we think will be a positive overall. So very different speeds on the economy, very different plays. We think that the net of this is the US will continue to attract capital. We also think it requires investors to be very selective when they're going around the world to look at where they're going to play. And we're still in the waves of the pandemic, even though it's starting to shift to more of an endemic issue rather than a pandemic issue. You're still seeing the waves. And this is pretty consistent with what happened with the Spanish flu, that even into the first and second quarter of 1920, you still were seeing the waves of infection, which I think what we're seeing in Europe and other places right now is not inconsistent with how past pandemics have played out. So switching gears, I want to talk about two things I got wrong. The first was the appointment of Lyle Brainerd as I thought she was going to be the vice chair of supervision and regulation. Yesterday, Powell was renominated as the Fed chair, which we believe is a positive for the markets. Brainerd is actually really moving into the role of vice chair of monetary policy, which we think sets her up for a Fed chair role or a Treasury secretary down the road. She is very much in lockstep with Powell in terms of monetary policy at this time, but she was viewed by the progressives as somebody who would really continue to carry the flag around employment and equality and dealing with inequality. So we think that that's a pretty significant change, her moving into this other role. It looks like the vice chair for supervision and regulation will go to somebody who's going to be very tough on regulatory oversight. The two names being bandied about are Fed governor from Atlanta, Bostic, and a former Fed governor and Treasury deputy, Raskin. Both of those will likely be tougher on banks and bank regulations. So, but I don't think Brainerd moving into the role that she's moving into is a bad thing for the markets. I think it's actually pretty good for consistent monetary policy. You just have to believe you like the monetary policy that we're putting forth from the Fed these days. The second thing that we might have gotten wrong, although it might be too soon to call, but it would change our view on inflation being transitory, goes to what happened with the Deere union contract, which included COLA increases, cost of living adjustments that are really a sign that inflation may be more persistent if this becomes broadly negotiated into other deals. One of the kickers is, and it's a pretty healthy contract, and I think these numbers are pretty right, but they would get a signing bonus of $8,500, which I think is effectively a 10% increase in their base year one, 5% increases in years 2 and 3, with COLA benefits that are tied to productivity increases, which is really interesting. If they heard if the company hits certain productivity increases, theoretically the COLA clause will kick in. If they're not seeing the productivity improvements, then the benefits might not be put through. So the real question is, do cost of living adjustments become embedded in all union contracts? And will they be tied to productivity increases, which if they do, will offset some of the concerns that people have about the wage inflation spiraling. But this is a big sign that Deere went with this contract. But you don't know if this is going to come out more broadly, but it is certainly a shot across the bow for people concerned about COLA increases coming back in. So, Mark, I'll stop there. It's a lot to cover. I didn't touch on the Build Back Better or some of the other things we talked about, but I'd be happy to take questions on
it. That's useful. As always, I've got questions, but let everyone else weigh in.
Yeah, Stephen, that's really interesting on the whole COLA thing, because for those who are old enough to remember, COLAs were a big deal back in the 70s and 80s during that inflationary period of time. And if I remember correctly, I heard anecdotally that at this, present day, that some of the COLA increases are equal to like the base pension amounts. So essentially, they've doubled their dollars for that. But yeah, that is fascinating to see it tied to productivity, because that makes a lot more economic sense and alignment as well.
The interesting thing is, for all the talk about the policies that drove manufacturing overseas, what doesn't get talked as much about is the COLA increases that went regardless of how the company was doing. The difference now, Bill, and I think this is an important element that is part of where the inequality issue gets addressed, is the concern that corporate profits were going up so much, the executives' comp and benefits was going up a lot, but the unions weren't. And by combining this with productivity increases, you're actually putting the company and the employees on the same side of the table to get the right balance. And I think that's going to be one of the interesting things. It just depends on how close the differentials are between the how much productivity has to improve and how much the benefits rise. But it is a big change, and it's still not 100% clear to us in our readings yet how closely it's tied into what parts of the negotiation it's tied to.
Have you seen this before, Stephen? This productivity link?
There have been, but not in a headline contract coming out of a pandemic like this. This could be a big thing. But the other thing to keep in mind is the pressures where they're negotiating right now potentially could be the worst we have for inflation. And as I talked about last week, I'm not saying it is, but if it was, and the other deals come as the labor markets get more normal and supply chains normalize, will there be as much power from the unions to continue to do this on future contracts? It's going to be interesting to see. But I think the other thing that comes out of this is, how much do you think companies who have union shops are going to change their spend to really go after more productivity increases than they already are? I think that's going to be the big issue. But I would argue that COLA forced a lot of manufacturing overseas. And if we don't get this right, you'll see it move to other lower cost producers, not China, but you'll see more going to other areas, maybe South America, maybe other South Asian countries.
Stephen, outside of the COLA, did the union get what kind of wage increase did the union get for their workers outside of the COLA?
Well, they got 20% increases roughly over the first 3 years. So they also got some increases on their benefits plans, which I think the number I saw for Deere, and I'm not sure this is an accurate number, is that the increase over the overall per employee would have the effect of something like $270,000 over between their benefits and their comp increases. So that not immaterial to them.
Do you think it would be fair to say that this is that this contract will serve as a reference point for other renegotiations with other corporations?
I think it's I think if I was on the union side, this would be a great starting point. If I was on the management side, it would be less applicable depending on the industry. I think that's how both sides will play it. But yeah, this is a good start for the unions. I think it's going to change the mindset of companies though, in a way that will drive them to accelerate any productivity improvements.
Hey, Stephen, it's Rob. Is there an age restriction on the Fed governor role? And it did seem like the Biden administration made Powell sweat a little bit in terms of the reappointment.
I don't know about the age limitation. I'm not sure of that one, Rob. I think the Biden administration needed to be thoughtful about how they were approaching this. It's a big, it's one of the biggest jobs in the world. You could argue that it's one of the, top 10 most important roles in the world. So I think it's not. I don't think it's one that they could move quickly. I think the inflation issues and how many things that the administration's dealing with all at once with the Build Back Better and all that, it was a safer move to keep Powell. I also happen to think he's done a pretty good job. I think that both times in 2009 and this time they might have kept the pedal on the metal a little too much, but I think Powell's very pragmatic and will make adjustments as the markets dictate. So I think you're going to start to hear more data dependency again from the Fed as opposed to a preset path. But yeah, he did make him sweat. I think that was political also for keeping his party in line to make sure that everyone had their say in it. But I think they probably threaded the needle pretty well by having the choice of the progressives and the choice of the more moderates still in the role. Although I'm not sure that the moderates were fully on board with Powell either. Other questions, comments?
Can we comment on Rob Colorina's ping pong?
No.
I will confirm that we're even now, 1-on-1 lifetime. I will also suggest that you had maybe a good hour and a half of practice before my only one game after coming from 2 receptions. But you did have a good lead on me. I'm glad I was glad to get 15 points. Yeah, I think it was 21-15. So I'll give credit where credit is due.
In certain sports, the most points would take the victory, right? As you go into the medal round. Anyways,
Is
other
Eddie
real
still doing a
questions.
victory lap, Mark, on his night that he had? Because I believe he was undefeated, but I'm not 100% sure.
I was, but let's settle it on December 15th, folks.
Yeah, or we'll just have to do this in the Hamptons again, Eddie. I think that's the good luck. That's the good luck table. But now,
I heard ESPN is doing live coverage from the award ceremony. So
the
Yes, the ESPYs.
Mark, I'm in Florida for some of this mix of things of Art Basel and some of these investor things. You guys are doing a Florida run coming up, right?
We're doing it in January.
Okay,
So-
so that'll.
But we could be a little nimble with your help, but we could talk about it.
Hey,
Okay.
if I could jump back to Stephen's presentation, I just want to acknowledge you for your honesty and calling yourself out where you might have been wrong on a couple of tiny nits. It's kind of like sometimes we leave a couple small mistakes in the tax return so they don't notice the big ones. I was expecting something more profound than the 2 tiny nits that you called yourself out on.
Well, these are the most recent ones. That's why I called out on it. The list is much longer, and I actually think Jonathan Dane's probably been the most accurate on inflation, and I'm not abandoning the call on transitory yet. I do think the Deere contract is a wake-up call, though.
Thank you.
I have a lot more that I've been wrong about the last, year. So I just can't, I don't like to remember all of them.
Nobody pays as much attention as you do. So I'm lost.
Yeah, Stephen, I took your
that. People forget very quickly. So well done, Stephen, for pointing this out.
Thank you.
Regards from London to everyone. And ping pong, Rob, next time you're playing with me. I played with Mark. He didn't mention that, so.
If we're going to talk about ping pong, let's throw this up there again. So we have, you see this, we're going to be, this is where the lunch is going to be. They're closing down this restaurant right here. And this is the ping pong. And yes, there will be a Zoom because of the award ceremony. And then there'll be a PCI session in the morning. But yeah, we'll have a number of tables. We'll try to set up everything so that we'll have a mixer and then have a little tournament.
And when is London planned? I saw it's to be announced. Do you have any idea which month you're thinking of?
Yeah. We usually did it in February, but we're doing February in the West Coast. So probably March. Yeah. And then we'll add on a few cities, and we have some ideas as well of which other cities we could tag on. Usually it would be like a Zurich, Frankfurt.
Tel Aviv. How about Tel Aviv?
Yeah. So we have a GCC Israel India tour.
Nice.
Yeah, that'll be our third to the Middle East, but first to Israel. And actually, yeah. Now that I've got you on board, Asha, we can get that. We can speed it up.
But John,
So London together with Europe. So you will be doing few cities together, not just one of them. Can you
London-
help? Reach out, and also I saw David Bolton here.
Yep.
For the first time, so he's also London-based, very strong in investment around here, so he can help.
Where are you, Miran? You sound like you're at a nice cafe or something.
That doesn't come from me. I put myself on mute, and I can still hear that. It's not me. I'm in a very quiet place.
Well, just before we leave, I wanted to talk. Stephen, you hit a few other things. Like, I think we focused on your last slide. It seems like you showed us all this data.
Mhm.
U.S. higher on inflation, lower on unemployment. Our market's been far higher than others relatively. Should we? I don't know if Greg's on here. How do we see the future vis-a-vis other markets, or how do others see it? What are the takeaways, I guess, from that?
Yeah, I'm on. Hi, guys. So yeah, we spoke about sell side initial predictions of 2021 and how most of that didn't happen, with the exception of the U.S. doing well. We're coming out of another crisis period, which was COVID, and what I seem to find interesting is that it's kind of a bit of a repeat about what happened after 2008, which is the U.S. attracting all the capital and everybody else struggling in different terms. With my guess is most of the emerging markets struggling more than everybody else, and Stephen pointed out dollar strength and high oil prices is another, and tightness, tighter monetary cycles in developed markets, and at the same time, EM's leading and tightening. You have a pretty bad combination for EM. I think Western Europe probably lies somewhere in the middle there. We'll see what happens with the Bank of England, and if they start the tightening cycle eventually on the 16th of December. So my guess is for 2022, more of the same, until some of these things start to look a little bit clearer, which is really not evident to me. On the Fed, really quickly, in 2018, when Powell was still hiking rates, and then had to do an about face. One of the views that I harbor was he was trying to regain control of monetary policy for the Fed a little bit, in front of, eventually, things were doing better, and also, to have some control over monetary policy if something happened. He got maybe halfway in terms of where everybody thought terminal rates were going to end and the likes. I'm going to put my foot in my mouth again and say he's doing the same thing now, and this time a little bit differently by basically blurring a lot of the markers that we had, right? So FATE, or flexible average inflation targeting, has become, that essentially, and nobody knows what those targets are. So that gives the Fed a lot of leeway. And then the inclusivity in employment, new definitions that we're all dealing with, now basically doesn't give you a very hard marker on what full employment is either. Gives you a lot of leeway to move around there. So that injects a lot more uncertainty into the markets. The last thing I wanted to highlight is, what's going on below the surface. I mean, the latest thing has been happening in the last couple of days has been a tremendous sell-off in EM tech. Not so much Chinese, because a lot of Chinese had migrated away from China, given what's been happening, and into some other EM tech options. But the last 3 or 4 days have been brutal in that space. Payment companies, software companies, online companies like C in Singapore, Mercado Libre in Latam, and that's mirroring what's going on below the headlines in Nasdaq, where you're seeing moves from the highs in some stocks that are 20, 30, 40, even up to 80% on earnings misses, on growth reassumptions in terms of the particular products that these companies deal in, et cetera. So those would be my observations.
Greg, how much do you think the weakness in the emerging market tech stocks is the rate increases that they're seeing? That's
a little bit of everything. I mean, so a lot of these Latam are fintech, and the higher rates should help because they make a lot of money off spread. So the wider the spreads, especially because a lot of them have been trying to verticalize. They were either online marketplaces that got into payments and credit, or payment companies that are now also doing credit. And that was supposed to be a very, very large growth area. My guess is, a lot of these companies are solid. I don't think there's anything wrong in general with many of the companies. There may have been something wrong with the multiples that got paid at the highs. And also we're now seeing a liquidation, right? Because if you take a look, for example, PagSeguro, which is a Brazilian payment company, it was a high flyer for a very long time. One of the largest holders of that is Melvin Capital. We all know what happened with Melvin and GameStop, and so there's a liquidation that there are some new rules coming out in Brazil that could have affected the prospects for the company, but nowhere near the type of liquidation that we're seeing. So there may be a bunch of liquidation going on as well.
I was actually more referring to the rate moves to the market multiples and the perception of it, not the impact of the rate moves on the company's business. But
I see. Yeah, sure. I mean, yeah. You're
I think
absolutely
that's
right. Yeah,
we saw that
higher discount rates. Basically give you a completely different PV.
Mark, the one thing I would say that is different I agree with what Greg said about 08, 09 and today. The one thing that's different though is in 09, China stepped up and really put a lot of stimulus to the global economy. Here, they're actually trying to slow their own economy down, stimulating in targeted areas. So it's put more of the growth driver back to the US, and I think that's changed. Europe was on the path to pick up a lot of that. I think the latest wave I think there's two things that are troubling them right now. 3. One is the energy problem that they have. Two is the immigration problem that they have. I think those two are creating a lot of challenges. And the third is the latest wave and the potential for lockdowns. I think that is actually going to be a bit of a setback for Europe, again, attracting more capital, I think, to the US and Canada. There are a couple other markets, but I don't think it's going to be very broadly benefiting.
Hey, Mark, I just had a quick operational question. Congratulations last week on executing the great, what was it, 2-day or 2.5-day forum. Roughly how many people were sort of visiting New York versus outside of the versus within the tri-state area?
Yeah, it's still low. We're not getting international.
No,
inbound.
but I think you had people coming in from you had people from Ohio, from DC. You had, you had a nice mix there.
I don't know, we had 215 people, about half and half in person Zoom, and the people in town. I didn't look at it that way. I'll look at it and get back to you.
Well, I
Rob,
was just saying just the thought there was that, what I've seen in some of these in-person conferences is it's easy to get local people, but then you've got people coming from out of town, and that's a compliment to the to the theme, in the spirit. And I think a number of people hadn't met in person yet, so that just added goodwill. I think you had some people in from Europe too. I think she came in from London, and so yeah, you had over 200 registered. It seemed like you had consistent following throughout. Plus, you broke up Midtown to downtown, and then a stroll. So that's
like doing something in New Jersey. That was a completely different place downtown. Peter Bohr started speaking, and there's like very few people there to listen to his. There are more people on Zoom but by the time he finished, getting downtown is not everyone's normal routine. But
it was easy. You just tell people to take the express train. It goes right there to Wall Street.
I know.
All right, I'm giving a compliment, believe it or not.
All right. Love it. You might win like 3 awards, by the way. So you have to show up for the award ceremony on the 15th.
Oh, one last quick story on Europe. I'm here at the Faena, and that was me with the music going on back there.
Oh, that in Miami?
Yeah, Miami Beach. But of all things, and Steve, I don't know, there was a message earlier about people's time and this and that, and I bumped into Mick Jagger last night here.
Of course you did.
Of course.
That's if Faena is a Mick Jagger place.
And anyways, it was I mean,
no, wait, but see, you're the kind of person who sort of positions themselves. You bump into him, you have a conversation, and where's the photo? You always get a photo op.
He was having dinner, and his security guy jumps up, and what have you. But I greeted him as I did greet him, and exchanged some quick commentary. But I don't know who. Actually, he looked like he was with somebody who was sort of ESG related. But he's got a unique appearance.
Yep.
So that's just a little to share from Bill's home state here in Adams' place of Florida.
Rob, did you give him any dance moves that pass on for his next concert? Anything you can share with him?
I told him he needed to consult Stephen Burr, because you clearly know the music, and then the dancing you've done. You've trimmed down from what I saw there at your offices.
But one of my clients, unfortunately, passed away. Was at a concert with, and was in the back, just talking to him for like a half an hour. He knows economics. He was an economics grad student, and we can wax. I mean, he'll talk about his investments. He's got like 5 advisors. So the angle is you leverage us for you. Get Mick in here.
Well, and just one other quick thought on that is, I think this year's Art Basel is going to be unique in terms of the embracement of these celebrities because of these NFT things. So you're seeing that with athletes, and then music and other models and other actresses. Maybe maybe in the 360 network, that could be one of your topics of forum. I only know just average on that area, but you're just seeing when you see Christie's and Sotheby's involved, there's money going on there, and then you see like from Tom Brady and Giselle, etc. So I think there's some things going on there, and I think Dominic's online and Nisa, they know more about the stuff than most. But anyways, food for thought.
Nisa just showed me this presentation. So we're gonna see if she can join us and shine a light on that. I don't know if Nisa's still on or not.
I'm here. Hi. Yes, I agree completely. Art Basel will be an NFT conference this year. And a few weeks ago in New York, there was a conference called NFT NYC, which 10x'd the amount of attendees and speakers and size that what it was in 2019. And so clearly, when we seeded Dapper Labs back in 2018, and that was the first year of that conference, very tiny. And it's just exploded this year. So there's really a lot of activity going on in the space.
But Nisa, I was at some of that. I went to like a handful of events at NFT NYC, but I think it's important to separate. I mean, there's a lot going on there, and I think there's value for filtering of what's what's real and what's marginal. So, food for thought.
Absolutely. There's a lot that's marginal.
From what I can see, your presentation is gonna would hit that. So would love to. I'll ping you offline, Nisa, and we'll just love, even if it's just you talking for half an hour. But if you want to bring some others alongside, that would be great.
Sure.
And I don't know if Dominic is on still, but that was a topic we talked about earlier. So, well, if it's okay, I've got to prepare for a few other things, but I can keep the Zoom going. But I want to wish everybody a happy Thanksgiving and just express that I'm grateful for all of you for leaning in the way you do. I think the more we lean in, we can help each other. So thank you. And
thank you, Mark. Thank you.
And look forward to seeing you after the holiday.
Thanks, Mark. And for next week, should we just talk about the game?
Which game?
Is there more than one this week?
Oh, yeah. 1 second. You can see my sweatshirt. This is the game. 12 o'clock.
That's right. Be there or be square.
This could be. I mean, Ohio State came out crazy strong. I don't know if you saw that first half.
Yeah.
49-0.
Yeah.
So, go blue.
Are they trying to break a 12-game streak? Is that what it is?
I don't know. What we should do? It's too late, but we should have had all the Michigan football players before. I hate to say it, before we possibly lose, but like we look pretty good right now. That we should just. It's too bad I didn't think about that. We could have had Amari Toomer and some of the others.
Sean Springs. Oh, he's on the other team.
Oh, we could have had a Ohio State Michigan. We're gonna have an Ohio State versus Michigan on the ping pong table. That's for sure. Well, listen. We'll don't call me on Saturday. Until